Let's talk about the 6 strategies that cash flow and make sense for Colorado real estate investors in 2026. I'm excited to share a replay of a webinar we hosted the very first week in January. It's called our Portfolio Analysis Mastermind. We start off the webinar by doing a deep dive into the Colorado real estate market trends. Then we spend time talking about the 6 best strategies that I currently see in the marketplace. I also share what strategies I'm implementing in my own personal portfolio. And then we're talking about how Colorado landlords can optimize their rental portfolio to maximize their cash flow to achieve their goals. Now, as a quick heads up, this is a lengthy, detailed webinar. It's close to 100 minutes long, so jump into it, enjoy, but also make sure you click the link in the description to get all the notes, the details, and the slide decks. Here's the webinar recording. Enjoy.
Good afternoon, everyone. Really excited to be here. We'll go and kick things off. My name is Chris Lopez. I want to welcome you to our 2026 Colorado Portfolio Analysis Mastermind. It's also known as PAM, P-A-M, shorthand. You will see that. It's not a person's name. It's how we refer to our flagship event. But look, this is our annual Property Llama flagship event, where we use a combination of our Property Llama software that helps people analyze and optimize their rental portfolios, along with market trends and the investment opportunities we're seeing in the marketplace. And the whole goal of this is to help give you an understanding of how your portfolio is actually performing and how to optimize it based off of your risk tolerance, your goals, with what's realistic in the marketplace today. So I have a lot to cover today. We've got 9 minutes booked out for here. I got lots of slides. I'm also caffeinated, so I'm excited to get going. So a quick overview on the PAM here is in Q4. So, last year now in Q4, I always start planning for the new year. I like to go in the new year with a plan and hitting the ground hard. And so I spent a lot of time researching the trends. And so this Portfolio Analysis Mastermind is our opportunity to share the research, the thoughts, the opportunities that we see that shape our investing theses and also our business strategies. So the goal here is to provide trends, insights, and resources for people to create their own investment thesis, create an action plan, mastermind with fellow investors, and then connect with opportunities that make sense for you. Now, I have a lot of data in the slide deck, and everyone can get a copy of these slides at the end of the webinar. So I will be going through it fast. I also threw a lot of extra slides and graphs I won't cover today, but that I found interesting in the last few months. So I wanted to share those with the audience. So this is our first webinar in the series, and this one is titled the 2026 Colorado Cash Flow Report, What's Actually Working Now. So to officially introduce myself, my name is Chris Lopez. I will be the host for today's webinar. And I know many on the webinar. I also see a lot of new names in the registration list. So quick background on me is a little over 20 years ago now, I graduated from Virginia Tech with a financial planning degree. However, I never became a financial planner, even though I have all the requirements to become a certified financial planner. But I am not a licensed financial planner, and I'm not giving financial advice. I'm sharing this because I have the passion for that financial planning, how to build wealth over the long run, and I've merged that with real estate, which has been pretty uncommon in the last couple of decades. And so a lot of the focus that we come at is how can you build wealth over the next 10, 20, 30 years in real estate? So I started building my rental portfolio in early 2011, right after the 2008 crash, did house hacking. I did one flip, did some wholesaling, and then I found my groove with long-term rentals and some light value add strategy. Then 2019, I started passively investing in a lot of multifamily syndications and also private lending funds for real estate. I'm also one of 3 co-founders here at Property Llama. Richard and Alona are my 2 business partners, along with a great team here that allows us to put on this education and structure a couple really good deals a year. So, quick disclaimer before we get into it, this webinar is for educational and informational purposes only. We are not providing financial advice. Always go out there and consult with your professional team. So, the agenda for today's webinar is I want to give you a quick overview of our Portfolio Analysis Mastermind because it's more than just this webinar. Then we'll spend a lot of time talking about the trends for the Colorado real estate market. Then we'll discuss what rental and investment strategies are actually cash flowing and make sense in 2026 in Colorado, plus a few national trends. Then we're going to talk about how to maximize the cash flow from your current rental portfolio. And then I will give a brief update on my investing strategies and also some updates in my portfolio. All right, now let's move into the fun stuff here and talk about the Colorado market trends. Now, I'm going to focus on 4 sections, and these are sections where I have found the most interest. I've done the most investing myself, and I see the most opportunities, and we have competency here. So it's residential, it's new construction, it's multifamily, and it's private lending. And I want to kind of give you a little bit of background on 2 themes I focused on this year that have really helped me define my strategy. The first one is understanding and forecasting supply or inventory. I think this is much easier to forecast than demand and interest rate forecasting, right? Supply and inventory is pretty much all public records, and we have a very good idea about what's currently out there and what's in the pipeline. Demand and interest rate forecasting, that's a lot more crystal ball stuff. The second theme is follow the money. Now, I constantly remind myself of this when I'm looking at investment opportunities, when I'm, pursuing business ideas, and it's really just understanding how a dollar enters the deal. Not just for me as the investor, if I'm putting the down payment or putting equity in the deal, but also if I'm investing into a single family rental, who is the tenant renting? What is their demographic? How are they paying for it? Or if it's a property we're building or flipping, who's ultimately buying the property, or is the flipper making the money? We have to follow the money, not just as the investor, but ultimately who is the end user, who is the consumer or customer on that property or that investment there. So those are 2 themes I've really focused on and have definitely influenced this presentation. So here is a chart that goes back from 2007 to 2005, and this is for the Denver metro area. So this is for the 11 counties that make up the greater Denver metro area. And this purple line up here that you can see, this is the active inventory. So this is single family homes, condos, townhomes that are available on the market. This dotted line up here, this is the amount of properties that have closed. So you can see here in 2007, 2008, this was during the great financial crisis, right? Where the huge housing crash. We had a ton of inventory. So inventories are incredibly high. Now, what's overlaid on this graph are these yellow, green, and even one red box on here to help designate, is this a buyer's market, meaning the buyers have the upper hand, or a balanced market, meaning it's, supply and demand are pretty equal, or is a seller's market, meaning the sellers have the upper hand. Now, if you go back, almost 20 years ago now, during the great financial crisis, it was a strong buyer's market for those couple of years where buyers had the absolute pickings of properties in the market, foreclosures in the market. And it was a great time to be an investor, great time to be a buyer, tough time to be a seller or property owner. And then around 2009, 2010, it entered into a balanced market. And then right around 2012, this is when the market started getting hot. And from about 2012 to like 2023, we were in a seller's market. And then when COVID happened and we had interest rates go really, really low, we were in a dysfunctional seller's market. And I'm sure a lot of you remember those times where there would be not only like 10 offers on a property, if it was an MLS property, but sometimes you couldn't get a showing on the property because there would be 30 people booked ahead of you and there were no slots to go tour the property. It was not healthy. And we saw a huge price increase. So I think it's really good to understand the inventory, right? Because this is inventory and supply we have up here. Well, once rates started going up, we started creeping up into a balanced market. And the number I want you to remember is about 15,000 homes in inventory. That's right around the line where it's considered a balanced market. Now, are we ever at exactly 15,000? No, but that's the range where we're in a balanced market of buyers and sellers. So now I want to show you the Denver Metro price appreciation. This is homes and condos. So the solid line here are homes. The purple line here are condos. So you can see since 2012, we have had a huge increase in prices. And then 23, we started seeing prices, flatten out. Depending on the market you're in, maybe some modest appreciation, maybe flat, maybe some price depreciation as well. But overall, pretty flat compared to like the crash or this increase. Condos, this purple line here is a different story. We started seeing condo prices decline the last year or two. Now, to really help understand the importance of inventory and price correlation, I put these two charts on top of each other. Now, the timelines for the years don't match up extremely well, but that's why I put this red box here, which goes from like 2006 to 2010, which was that financial crash time. And you can see here when prices were going down, what was inventory? Inventory was very high in the buyer's market and in the upper end of a balanced market. Well, starting in 2012, when the market started getting better, everything recovered. What happened? Supply or inventory started going down below that 15,000 home inventory, and prices started going up. And you can see here, even in that 20, 21, 22, when inventory is very low, what did prices do? That's where we have the steepest part of the curve right there. So there is a strong correlation here between inventory and prices. So I will not go through all the numbers on here. Again, you can download these slides and do it yourself. But this is the November report from the Denver Metro Association of Realtors. And it shows the current prices and the current snapshot of how the market is. So this top part is residential, detached, and attached. So detached is like your single family homes. Attached are your condos. So you can see here, detached, we've actually had year over year, we've had that like 1 to 2.5% price increase based on median and average prices. Attached properties were down 5, 6, 7% year over year. So that's starting to show how those two different asset classes, how they're going in different directions. All right, so those are the key points on there for like Denver and also supply, demand, and how prices interact. Now, I want to quickly go through the rest of the front range and show you how the other markets are doing. So here is Colorado Springs versus Denver. Springs is this purple line here, and this is homes on the left and condos on the right. Now you can see here the single Colorado Springs market is less expensive than Denver, but it follows very similar trends to Denver in terms of the single family price appreciation and also what condos have done as well. Now, here's a snapshot of the Colorado Springs months of inventory. This is another way to look at how much inventory is on the market. Basically, this says if no new properties came on the market, but we still had buyers and demand out there, how long would it take for all those properties to be bought or sold by the buyers? So you can see here, right around that 4 months is where we say this is a balanced market. So if no new inventory came online, it would take about 4 months and change for all those properties to be bought before it was zero. So you can see in sometime in 25, we entered the early stages of the balance market, just like we did in Denver. Now let's look at Pueblo versus Springs versus Denver in terms of like long-term price appreciation. Pueblo's on the left here. Denver's in the center. Springs is on the right. Again, you can see They all have very similar patterns in the growth, and they're not too far off from like their annual average growth rate. Pueblo's at 4.5%, Denver about 5.25%, Colorado Springs about 4.75%. So all very similar trends and patterns here. All right, so let's drive up 25 and look at Northern Colorado quickly. So the purple line is Northern Colorado. The left is homes, the right is condos. This green line is Denver. And you can see the Northern Colorado prices are a lot closer to Denver than Pueblo or Springs are, but they follow the very similar pattern here of whatever Denver does, these other markets do as well. So same thing, here's a Northern Colorado months of inventory, and you can see they are just starting to creep up into the balanced market as well. So all these markets are pretty similar, which brings me to a key question here. What do you notice about these trends? Well, they're all similar across the front range. No one market is significantly better or worse than the other market. Historically speaking, Denver usually leads the pack. And within 1 to 3 years, the rest of the markets, including the mountain markets, kind of follow what Denver does as well. So tons of similarities there. So I highlight this because as we go through opportunities on here, all the markets are going to face very similar headwinds and also see some very similar opportunities as well. But like you going to Springs or Pueblo or Northern Colorado is not going to be a significantly better advantage than staying in your market. All right. So let's have some fun here. Let's do some crystal ball guessing. And these are my estimates. They're my guesses, I'll say, on where I think the market is going and how I'm planning my investing strategies and my business strategies as well. So, will detached home prices crash? So, this is not condos. No, we are not going to see a price crash in single family homes. I label this right now as we're in a great stall, STALL. We're going to see some minor corrections in prices. I actually think prices will be slightly negative year over year. I mean, I'm talking like maybe down -1 or 2%. So pretty flat on here. But you can see here since 2023, it's been pretty flat. Not going up, not going down, but kind of choppy here. A question in the market or in the chat here: are the mountain trends truly experiencing similar trends, including a softening? Yes, they are, Patty. I don't have data in here, but I have a great podcast from a month or two ago that we can link in the resource page. Or if Jules can find that, we'll drop a link in the chat here. But the mountain markets are seeing very similar trends here to the front range in terms of correction and what we're seeing in single family homes and also condos. All right, now I want to pause here because I have not talked about new construction yet. There's a big difference in the resale market. Resale is the word for existing inventory. You go out there and buy a house in Lakewood or Highlands Ranches built in 1990. That's a resale property, right? You're buying it from someone else. It's not a new build or new construction property. So, are new construction prices going to crash? Yes, they have crashed. So my prediction here is that in 26 and 27, it'll be a great window for buying great assets at a fair price, but cash flow will continue to be tough. And what's going on here is, we had a lot of builders building properties, from 2018, 2019, 2020 and on. And building properties takes a long time through permitting, especially if you're in Denver or Aurora. I've never heard anyone say nice things about that permitting office who built properties there. And so they take years to develop and they say, wow, we can sell this townhome for $750,000. And then the market, they deliver the products in 2024, and now those properties can sell for $600,000, significantly less. And so these builders, they build to sell. They don't have that 30-year fixed debt like we have, at 3% in our single family homes where they can just ride it out. They have to sell it, or if even try to rent it, it's very tough because they have to go out there and refinance those properties at much higher interest rates. Now, what you're seeing here is you don't see those prices drop a lot on paper. So, what the builders are doing is they have greatly increased their closing incentives, somewhere between like 7 and 13%. And so, what this is rather than dropping the price by 10%, you'll get 10% of closing incentives. Interest rate buy downs, right? Have you guys seen any new builds where you can get a new build property with a 30-year fixed at 4.5% interest rate? Well, because they're spending $30,000, $40,000 on buying that rate down. They're doing property upgrades. They're covering closing costs. And they do this because they want to keep their comps stable so they can keep selling the properties and helps them with their financing on the back end. So resale properties, we'll see like 1 to 3% in closing incentives. New builds, we're seeing double digits. So builders need to sell, and especially with the smaller builders, they don't have the capital or the ability to ride out the tough markets where they can just hold on the inventory. So here is a chart of national public builders that kind of shows what they're seeing. I won't go through it, but you can download the slide deck and review that yourself. But there are some good opportunities out there in new construction. All right, so let's talk about the condo market. Here's my crystal ball for condo prices. Um, are condo prices going to crash, stay the same, or go up? This is not a hard one, in my opinion. Condo prices are crashing. They were down last year, and I think condo prices will be down another 4 to 10% this year. I have no idea where the floor of condos are. They are probably the hardest asset in the market right now to sell or maintain. Interest rates have now have gone up, but HOA costs, insurance costs, everything has gone up on there. And it's made it really difficult for the condo market out there. Now you can see I added some red lines on here to kind of show where I think prices are going. Uh, don't measure it over here across the y-axis. It's just to help illustrate. I think prices will go down for condos. I think detached properties will go down very, very slightly. Of course, the vintage, the year built, what part of town it is will have an impact. But overall, condo prices will be going down in 2026. All right, now I want to move on to multifamily. Now, these charts here are from CoStar, which is like the main data source for commercial properties, commercial multifamily. So these are 5+ unit multifamily properties. So not the fourplexes and duplexes where you can get 30-year fixed financing. You get the commercial or bank financing on these properties. So a very different asset class than residential and even like that 2 to 4 unit multifamily. So there's a lot going on this chart on here. But I will start off with these blue lines. So these blue bar graphs here, this is new delivery. So this is new properties being built out there. So they're being built and then the market can go out there, the rental market can go out there and then rent it, tends to go rent it. The orange vertical line is absorption, meaning how many people are renting the properties. So it's very much supply and demand. So what do you see here in 23 and especially in 24, deliveries just started greatly outpacing the absorption on there. We've all driven through downtown. We've all seen the number of cranes out there. We've all seen those 200, 300 apartment class A buildings going up. That's all the supply hitting online here. And then there's a strong correlation between if there's a lot of supply out there, was that due to vacancy? If 10,000 units come online, but only 8,000 people rent them, we have 2,000 vacant units. So you can see as new deliveries come online, this green line is our Denver vacancy. Yellow is US. Look at the green line here. Vacancy goes up, right? Just that is simple supply and demand on there. So vacancy will go up on here. Now, CoStar forecasts right about now, end of Q4 in 2025, Q1 2026, that will be peak vacancy. And that's just the lag impact from all these deliveries in 24 and 25. So, what does this do out here, or what does this do to rents, right? So, if we have high vacancy, what happens to rents? Rents go down. So these bar graphs here, or these orange graphs, is market growth rent. And you can see here, when there was a lot of absorption, rents were going up drastically. Well, once we started having all these deliveries, which causes vacancy, we start seeing negative rent growth. And so what's happening here, these Class A buildings, they have 300 units come online. They're going to give really strong rental concessions. And a lot of times we're seeing 2, 3, 4 months of rental concessions. If you sign a 12-year lease, you might get 2 or 3, 4 months rent worth free on that lease. And they need to go in there and fill the vacancy so they can refinance their construction loan or sell their property. But then with rents dropping, it has an impact on their prices. And then as rents drop, it has a ripple effect across the whole market, right? And this is why then we see small multifamily and especially condos right now. We've seen those rents drop as much or even more than these Class A multifamily. So CoStar forecasts that through about the end of 2026, we will continue to see negative rent growth. And then starting in 2027, we'll probably start seeing a positive rent growth on there as well. So here is Colorado Springs data. This is the absorption net deliveries. I won't go through all the details on here again, but very similar patterns to Denver. Colorado Springs is probably a little bit farther ahead than Denver is in terms of like their supply coming online, but very similar factors. You can see CoStar says we're already past peak vacancy, which happened at the end of 2024, so about a year ago, where we think Denver's peak vacancy is this year. Again, very similar trends. Here is their rent forecast as well. Very similar trends to Denver. Now, here's a graph for this is Denver again that shows the price per unit and what is the sales activity. So this blue line is the important one. This is the price per unit. So right around in early 2022, this is when we had peak price per units, right? And that is right before interest rates started going up. So interest rates were low, which really causes multifamily prices to go up and increase. And then once rates started going up, among other factors, expenses going up, vacancy going up, insurance going up, we started seeing prices come down. So it peaked about $380,000 per unit. And this is really geared towards like the Class A and the newer build stuff, but the market follows these trends. And you can see right around here in 2024, it has started to bottomish out. And they expect, sometime in 2027 for prices to start creeping up. And then probably around 2030 for prices to be back where they were in 2022. Of course, that's all forecasting, but it shows the decline we have seen in multifamily prices. I put this chart in here for cap rates. I thought it was really interesting. Cap rates will inversely mirror what prices are doing. Colorado Springs, multifamily as well, very similar trends, where we had the peak of prices in 2022. Prices have come down, and they think price will start recovering in 26 versus 27. But again, we're talking, best guesstimates on here. So, crystal ball. Will multifamily prices crash? Yes, they've already crashed, right? I probably should have asked that question before showing those charts of the prices on there. But I think it's pretty clear that prices have already crashed. Are they going to go much lower? I don't think so. They might go a little bit lower, but I think we're very close to the bottom-ish of multifamily right now. So I think 2026 and 2027 is a great window for buying great assets at a good price. But cash flow will continue to be tough in the market. Again, we have all these high vacancies still, expenses have gone up. As I've talked about as well, we've got a lot more headwinds than tailwinds we do now. But there'll be some great opportunities by multifamily. But I still think if you buy it now, you get a year or two of just very choppy and tough times. And this is someone I bought a lot of multifamily. I called the market right where the prices were crashing. I started buying multifamily right around here in 23. Wrote it down some, and we bought at good prices here, right around the price we are now. But it's been a very, very choppy couple of years. I think I'll maintain from there a year or two before the market starts turning around. Oh, good question here. Aaron says, how do you define a crash and how much does a price have to decline for it to be considered a crash in your opinion? That's a great question. I would consider a crash and this is not a hard number of signs for me, but I'd say about 15% or more from like peak price to trough. In the great financial crisis, we saw like 20 to 30% price discounts. And that's kind of what we're seeing in some asset classes on here as well. So that's a very loose definition for me there in 2026. Diane asked, what is going to cause the pricing to go up for multifamily in 2027? It's because we don't have new properties coming online, Diane. I think it's yeah, Diane. So I'm gonna go back here to net deliveries if my slides will cooperate. So here's that Denver CoStar chart I was showing you. And get back up there. It's because this big pipeline, we got properties being delivered. There's almost no new construction coming online. Like I said, inventory is the easiest thing to forecast because these buildings take years to build, right? They buy the property, they have to apply for permits. These are 2 to 5 year building processes. So a lot of these are projects that are started in 2018, or I'm sorry, 2020, 21, 2022, and now they're being delivered. And between the interest rate changes and some laws on affordable housing units they have to make in multifamily, there's very little new supply of properties coming online. So, not much new supply, and we still have decent demand. So, once this supply gets absorbed, we're going to go back into we don't have this glut of supply. I see some questions out there about population. Hold your horses. We'll get there in a minute. That's a very good question. All right, let me get back to my slides on here. All right, there's one question I want to answer before I move on to the next segment on here. Eric asked, will townhomes mirror the condo market? So, yes and no. So condos and townhomes are different, right? Townhomes, you own the land beneath you. Condos, you don't. That's like the definition on there. But there's still typically attached property, and you have shared walls or shared neighbors on there. Um, Townhomes are kind of like in between the condo and detached home market, where they are not crashing like condos are, nor is their price as strong as single family homes. So they're kind of in between right now. Now, unfortunately, I found it hard to get really accurate data because they both get lumped as attached properties and market data. So it's hard to get really accurate data between condos and townhomes. But what I have seen, I think townhome prices have gone down slightly negative, not nearly as much as condos, but they have not stayed as strong as single family homes. So townhomes are a much better position than condos are. All right, let me check for the questions here. All right. And for a lot more like the details on here, we do monthly podcast updates. I have a great group of like 3 or 4 panels that join me every month. We do monthly market updates. Come join those or listen to those for like monthly updates and a lot more granular data. I'm trying to give you like the 5 year broad strokes. So the last thing I want to talk about here is private lending. And this is something I got into a few years ago because in today's market, getting good cash flow requires real work. So as a landlord, I ideally target about 7 or 8% annual cash on cash returns. Even with prices going down, generating strong cash flow is difficult without using creative strategies like a room by room or short-term, medium-term rentals or a heavy value add process. And so at this point in my life, my time, as everyone's time, has a high opportunity cost. How much time do I put into there to help juice the cash flow returns versus how much money do I put in there? At this point in my life, I'm older, I got family, I got work, I got things, and I got more money than I did 20 years ago. I'm much more about how to make my money work harder for me versus me working harder to go out there and get a better cash flow return. So, I don't know, about 3 or 4 years ago, I started lending money. for 10 to 20% annual cash on cash returns with less risk. So this is a picture. This is known as the capital stack, meaning when you buy a property, you have 100% of capital. Where does it come from? And typically it's a blend of what's called common equity and senior debt. Ignore preferred equity and mezzanine debt. These are very minor in the capital stack structure. Most of us are common equity or senior debt, but these are all the four types on here. So if I put down a 25% down payment on $1 million multifamily, I've got 25% down payment in equity, but then the bank I'm borrowing has the remaining 75% of the capital stack, but their debt. So typically, if you're the equity holder, you have higher risk with higher reward, senior debt, lower risk, and lower return, right? Before the bank loses money, my 25% down payment or my $250,000 down payment needs to be wiped out. And that can be, a lot for the market just wiping things out, right? A lot has to happen before the bank loses money. So I started private lending. And when I say private lending in real estate, this is where banks don't step in. This is for fix and flippers, bridge loans, short-term loans where like Fannie and Freddie, your community banks, they don't go out there and really lend money in these asset classes. So this is a chart that shows the gross margin. So this is like the rough margin that a flipper will make on a property. So for example, if a flipper buys their property for $300,000, they sell for $500,000, they had a $200,000 gross margin. Doesn't mean profit because in between there, they have closing costs, they have their holding costs for the loan, and they've got their rehab costs of, $40, $50, $60, $70,000 in there. But this pulls MLS data and shows from 2005 to about 2025, the gross margin that flippers are making. So right now, flippers making about $180,000 in gross margin, which is a little bit below or about a 24% gross margin on there, which is a little bit below the average of 30%. But bottom line, flippers are making money still, which I think is a very important sign. Again, follow the money. If I'm going to lend money to a flipper, I want to make sure they can sell the house. I want to make sure the flippers are making money because if those two things happen, I'll get my money back and I'll get my profit back in interest and fees. So here's a very detailed numbers if you want to dive more into it. I won't go into it. I will make one note on here though. This is pulling MLS data because that's the public records that we have access to. I think about a quarter to a third of flips, I would say, come from MLS. This is from flippers I know, or maybe about 2/3 or 3/4 comes from off market. But from flippers I know, it's all about the same like numbers, right? They source from other places. But even though this MLS data is a minority portion of the data, I think it's fairly accurate. And I've seen off-market deals and on-market deals, and I've seen similar trends on here. All right, so last crystal ball here. Does it still make sense to lend money in 2026? Yes, it does. Property values are down, as we've discussed, so it's providing that cushion for lenders. And also, flippers have adjusted to the new market. And hey, if we were lending money 3-4 years ago, we're going from a hot market to a low market. That's where a lot of flippers and some lenders got pinched, right? Nowadays, it's a lot less common because everyone's adjusted to the market. The other thing I look at, even the worst times on here in gross margins, right? From like the gross margins that flippers are making. So in 2006, 2007, 2008, in the toughest times, and the market was way worse than it is now, they're around a 22% gross margin. This is that purple line I added on here to kind of show the line of resistance. Fast forward to here, and you can see in 22 where the market turned, they were at 21%. That was the hardest, the market turn was the toughest. Went up some, but now it's bouncing around 24%. So I highly doubt gross margins will fall below like where they were in the 2006, 2008 crash timeframe. Because if flippers can't make the money, they're not going to buy it. And since the market is already adjusted, they know how to forecast their ARV, their after repair value, a lot better because they know where the market sits. All right. If you guys got any questions, just post them in here. All right, cool. Let's keep marching on. This is fun. All right, next segment in the presentation here is what rental and investment strategies cash flow in Colorado. So we've identified 6 strategies. That makes sense. Again, very broad stroke for really the front range in Colorado. But before I cover those, I want to take a step back and kind of contextualize some of the data we talked about, along with where Colorado is in the 10, 20, 30-year macro cycle. My belief is that the epic growth wave we have is over. An epic. We all were here. Or if you were here from 2010 to 2020, you know what prices and rents did, right? Like it's not sustainable. And I would describe it as an epic growth that we will never see again in Colorado. And it's just a ton of reasons why. So one is supply inventory, which I've already covered ad nauseum. I want to talk about population growth in a second, interest rates. And I got really good graphs for these here next couple of slides. And then 2 other points I don't have slides for that are worth mentioning is that around 2022, Colorado as a state started passing unfriendly landlord and business legislation. And I'm not getting political here. I'm just saying, hey, when legislation happens, how's it impact me as a business owner, as an investor owner? And it's made things a lot tougher. I think a lot of you guys have seen the emails and podcasts we've done. If you self-manage or a property manager, you've probably seen some of the stuff they've passed last couple of years and just making it tougher to be a housing provider, right? The other thing is we had really low expenses through the 2010s. And then after the supply chain shock of COVID and the inflation we had, taxes, insurance, labor, everything just shot like double digits. Those expenses are stabilizing now. Taxes are stabilizing, insurance is stabilizing. I saw a headline a few days ago, I think in the Wall Street Journal, that Colorado is the second most expensive state for property insurance now, just behind Florida. So we just had expenses go really high, but they are stabilizing. So all these factors come into play where we've had the epic growth wave. It's over now. So someone asked earlier, I think it was Diane asked earlier about population growth. Here is a chart from the Colorado State Demography Office. And I really like this chart. And I will link to all these sources too in that resource page so you guys can dig in the full documents. I picked out the few charts that really stood out to me. These blue lines here are the net immigration. So new people moving to Colorado. This lighter gray is births minus deaths. So people that live here in Colorado, new births minus death. So you can see here the 80s, 2000s, we saw a lot of growth, 2, 3, 4% growth. Now, we're around here in the market or right here in this time, 2025 timeframe. We're going to probably be around a 1% population growth. So the growth has greatly slowed. But importantly, we don't think it'll go negative, which is a very important thing. Here's another chart I want to show. This top chart is that Denver prices I showed earlier. This bottom chart is from the Fed showing interest rates. And this is something I really started focusing on this last year. If you look at, from the peak interest rate in the 80s, right, where there was that crazy inflation, we've had 40 years of declining interest rates. This is another factor. This is a national macro factor that's actually, helped Colorado had huge price increases. Well, once we got to post-COVID, right, interest rates could really only go up versus down. Interest rates started going up. What do you see here on the chart? Prices mirror that, right? When interest rates were going down, we saw prices going up. Rates shot up, prices have flattened, or in some cases, they are going down based off condos or multifamily, right? So we have a very big macro headwind on interest rates, and then also with population growth. And we have zero control over that. But these are good facts to understand. All right. So, Chris, what do these trends mean for Colorado? And I'm a big believer in keep it simple, stupid. So I like to do a red light, green light, yellow light type analysis. So Colorado real estate investing is no longer a green light. So the easy days of real estate investing over, where you can put a decent down payment down, find a pretty good deal, and just have strong rent and appreciation growth. Why? Population growth has slowed, or, back then we had strong population growth, but now it's slowing. We had low inventory. Inventory is increasing. We had low interest rates. Now rates are up. We had low expenses. Now we have high expenses. So I would classify Colorado as a yellow light. Not amazing, not horrible. And that just means strong cash flow and strong growth is tough now without creative rental strategies. Doesn't mean it's not a good time to invest in the market. It just means investors need to be more selective in location, really buying right, and updating their playbook for what strategies they're utilizing. Because the strategies that worked in the old market really don't work very well in the new market. Now, fortunately, we are not in a red light. I don't see us going into the red light. Red light to me would be negative population and job growth. If we have negative growth, then we're in trouble. Fortunately, we don't. Things have slowed down, but we are not negative growth. And if we were, it would be red light. And if it's red light, don't invest. And that's why I never invested in some of these, like, I'm sure you guys saw it, these like markets in the Midwest where you see these amazing cap rates, amazing rental numbers, but they're like one factory or one employer towns. The employer leaves and then everyone leaves the town, right? You don't want to be in markets like that, in my opinion. All right. So the strategies that work. Strategy number one, new construction. As I talked about, we've seen prices crash on there. And we are planning a webinar and a property walk, both to buy them directly and also some passive investments. Don't have the details out yet, but we know the opportunities, is trying to coordinate the times, locations, and property walks are a big pain in the butt to coordinate, but we're working on it. Strategy number two, room by room conversions or co-living. Go buy a 5-bedroom house, add 4 bedrooms, add a bathroom. Now I have a 4-bedroom, 3-bath. Now it's an 8-bedroom, 4-bath. And rather than renting out to one tenant or one family, now you rent out each unit to an individual tenant. Strategy number three, medium term rentals. So this is 30-day longer rentals. So not short term and not long term rentals, but these are fully furnished medium term rentals. We are planning a webinar and a property walk here in February. So stay tuned. Strategy number four, house hacking. Now, house hacking is where you go out there and you buy a house and you live in it to get that favorable low down payment and better interest rate. Go buy a house, put 5% down, live in it for a year or two, move out, turn to a rental. It is a great way to go out there and build a portfolio if you're in that phase of life. Now, if I turned 44 this year, if I was turning 24 this year, I'd be house hacking and doing room by room conversions. But since I'm almost 44, I just don't have the desire to have roommates or put that amount of sweat equity into projects anymore. We have a lot of great resources on here existing. Read our book that we published last year. We have monthly meetups on there as well. Let us know. That's a totally different investing strategy, but it's a great one. I always have investors who are in the 40s, 50s, or 60s, and they got kids or nephews or nieces. If you want to help them get into real estate investing, this is a phenomenal way to go out there and do it. Strategy number 5, private lending. We already have our deep dive webinar scheduled. We're doing that January 21st at 12 Mountain. As I said, this is an area where I put a lot of my own capital in, and we're doing a big focus as a business as well. So we have a deep dive webinar coming up January 21st on there. So if you're interested in that high cash flow, lower risk type strategy, come for that webinar. And last but not least, and I'll say these strategies are in no particular order. They're not ranked. I just put them out here in random order, is multifamily. Prices have crashed, and you can go out there and buy really good assets at a good price, both in that 2 to 4 unit and that 5+ commercial. So we are planning webinars and also a property walk. Big asterisk next to the property walk. Tenant occupied multifamily is really tough to property walk. So when the stars line for vacant property, we will try to line one up. One note I'll put on here for multifamily is a segment of multifamily that I really like is called build to rent. And this is not your vertical multifamily. This is where people go out to either buy or build, think of like a subdivision of single family homes, 100, 200 single family homes. And it's all one manager, all one landlord, but it's like a horizontal apartment complex. So you get the apartment complex efficiencies, but the residents get the single family style of living. We have a deep dive webinar scheduled, I think for next week. We'll send an email out to that for everyone, but it's a really cool part of multifamily. And I think this is going to be one of the fastest growing parts of multifamily over the coming decade. All right, so let's move on to the next segment here on how to maximize cash flow from your rental portfolio. So this is the portfolio optimization, right? How do we take these trends and what makes sense to market and how do we merge it with what you are doing as an investor and make sense in your rental portfolio? So an equation I like to look at, and this is a new one for me, I really focused on this year, is cash flow, right? Not cash on cash return. I jumped the gun here. But we all know cash on cash return. It is your cash flow after expense before taxes divided by your total initial investment, your down payment, your acquisition, your rent ready cost. If I buy a place for $1,000,000, I put $100,000 into it. I make $100,000 a year or $10,000 a year, making a 10% cash on cash return, right? So it's a great metric to go out there when you buy a property. But once you've owned the property for 3, 4, 5, 10, 20 years, is it the best way to measure performance? No, it's not, because you no longer have just your investment in the property, your money you put in there. Even if you put a zero down payment in there, you have now equity, and that is today's value minus your mortgage balance. And so most of us landlords, we have gained a lot of equity from paying down our mortgage or our tenants paying down our mortgage, from the market appreciation, and also adding value to the property. That increases the equity. So this was one of those aha moments I had on here about understanding cash on cash return was not a great way to measure things. So here is a real condo I bought in 2011, and I bought for zero down. So awesome financing, zero down. I didn't have my first money in my pocket until 4 weeks later when I wrote my first HOA and mortgage check, right? It was amazing. And I was like, why would I ever sell this property? I have $0 into it. Well, once I learned I have equity in there, I had $200,000 of equity, it changed the game. So I'm going to switch over here to another window. Cool, it's appearing. So this is our software called Property Llama. And this is the software that we built, myself and two business partners. Really cool software that's for analyzing your current portfolio. Go there, create your free account, but I want to show you why this matters on here. Now, it's showing this dotted green line because what happens when you put $0 down but you make money? It's technically an instant return. So you go out there and have an instant return on the creative financing or creative strategy you use. But after you build equity, you have real money in there. It's like your real estate piggy bank. And does it make sense to take money in that piggy bank? And by that, I have about $200,000 equity in this property. I no longer own this, but it's a great case study. So I'm going to play over here. And if I take out appreciation, debt pay down, and depreciation, and it just shows, hey, what's my cash flow over equity? So I'm making $1,700 a year in cash flow, divided by $200,000 a year in rent. I'm making a 0.8% return on cash flow. Well, when you think about that, like, it's not horrible, but when I go out there, my savings account and make 3%, 4%, well, if my main goal is cash flow, it begs the question, I should be getting better cash flow from my property and my investments when I can get a risk-free return in my FDIC savings account, right? So there's a lot of cool things here in the software that I won't go into, but we have more training on here. If you've not seen it, go create your account at propertyllama.com and we'll get you squared away with how to do like all the details in here. But I'm going to go back to the slide deck here and actually talk about this cash flow and equity. Because if I'm making this amount of cash flow and equity, I'm not thrilled as an investor, and I can make that equity work harder for me to go out there and create more cash flow. So here's what I call the cash flow or CFE, cash flow and equity traffic light system. Again, red light, yellow light, green light. Red light. And this is kind of arbitrary. You have to pick your number. But for me, I'm using, savings accounts, government bonds. It's kind of like the risk-free rate of return. And they're paying, 3 to 4% right now. So if I'm below that, I can make the case if my number one goal is cash flow, I should sell it and just go invest in savings accounts, T-bills, bonds, where I'm, guaranteed that cash flow and I'm not worried about, losing that money. So if it's below about 3 to 4%, I classify that as red light. Yellow light to me is at 4 to 8%. Again, I want to target about an 8% or greater cash on cash return. So this is my numbers. You have to pick your numbers out here. So yellow light, hey, returns are decent, not exceptional. I will need to optimize your property to go out there and make sure I can increase the cash flow or doesn't turn that red light range. Above 8%, great, I'm happy. My property is performing well. My equity is working hard for me. So your action, your recommended action on my end is determine the cash flow on equity of your properties and then determine what cash flow and equity are you happy with. Are they red light, yellow light, or green light? Go out there and determine where you sit and what you're happy with. So go to propertyllama.com, which I just showed you. I'm logged in here, but if you just go to propertyllama.com, go create your free account. It'll take you through an onboarding process. It takes a few minutes to upload per property. You'll get a really good snapshot here, and you'll start getting emails that show you how to upload the properties and analyze them and all that as well. A couple questions here. Does the cash flow and equity work for properties that were purchased with 1031 exchanges? Yes, it does. Great question. Yes, but it works because it's all about what's the opportunity cost on there. As you model out your exit scenarios, which we'll get to in a minute, you have to determine, hey, how much do you want to minimize or do you not care about the potential tax consequences on there? So what I'm sharing here about that high equity but low cash flow is something that's not just a problem I've had, but most investors. And I call this a good problem to have, right? Like it's not a bad problem. It's a good problem to have of like, getting wealthy and what the market has done. Now, here's the reality for a lot of us in Colorado, the majority of our returns have been through appreciation. It's just been it's been through market appreciation, right? We bought in 2012 and then prices have tripled since then, right? So now in my mind, the trick or the play is to go out there and convert the equity into cash flow. Like I talked about in that zero down condo at an instant return on my investment by making less than a 1% cash flow return on my equity. So you have three main options with any rentals. You can keep it, do a cash out refi to reinvest, or sell and unlock your equity. And there is no right answer, but I'm going to show you different options and walk you through the framework so you can determine what's best for you, your portfolio, and your family. So option one, some keep opportunities on here. Most people have long-term rentals, but on long-term rentals, you can only increase rent so much and you can only decrease expenses so much, especially with all this new inventory coming online from apartment buildings. We've all seen rents soften for the most part, or rents decrease, right? Condos and multifamily has been worse than single family homes, but overall rents are down, generally speaking, in the market. So the best opportunities are to convert that single family home into a better cash flowing strategy, the room by room or the medium term rental. Now, of course, one thing to always look at is, are you happy if you just pay off the property with the cash flow? So let me jump back over to Property Llama. And by that, I mean, you look at your NOI here. This is NOI is your net operating income. This is your rent minus all your property expenses, property tax, insurance, management, HOA, maintenance, utilities, but not mortgage debt. So it shows you how much property pays if it were paid off. come in here and determine, hey, are you happy? And I've met a lot of people, if they just spend another year or two paying off their properties, they hit their cash flow numbers. And sometimes that's the best move for them. For a lot of people, they're not at the cash flow number where paying off their properties won't allow them to hit the cash flow number they want. All right, so here's some quick examples. And for just efficiency, I put the screenshots from Property Llama just to save time from like real time modeling the software. But here's a property looked about a year ago, single family home, 5 bed, 2 bath. I think it was Westminster. Yeah, Westminster. Um, Low LTV, not quite paid off, but low LTV. Cash flow was about $11,000 a year. Investor wants more cash like we all do. So option, let's go convert to room by room. You self-manage it. Cash flow goes crazy. It goes from like $11,000 a year to $48,000 a year. Amazing cash flow, right? But he's self-managing 8 tenants in one house now. Again, great strategy. Just depends on if you're in that phase of life. This third option on the right here is a company called Pad Split, which is like a third party company that helps to like do the management, do the conversions, find tenants. They do a lot of like the property management, with you, and they charge a fee. You can still do that, but then your cash flow is like $35,000 a year. You're still having to manage the asset and do it, but for cash flow, that room by room or co-living conversion can be amazing. I won't go through some of these like detailed slides, so you can download the deck and read those on your own. It just kind of gives some of the facts to the charts I'm showing. Next one, medium term rental or MTR. Again, these are those greater than 30 days. They're typically like 1 to 3 months or 1 to 6 months, as some people extend. Traveling nurses, digital nomads, job relocations, divorcees, people who had, unfortunately, house disasters. They can't live in their house, insurance relocations. And we see good opportunities in like 1 or 2 bedroom conversions, or like 5+ bedroom houses. So like 1 or 2 people will rent a medium term rental, or a family or grandparents will come rent a whole furnished house. Last year, Key Renter Denver, a local property management company, they opened up a medium term rental division, and they were the first local property manager I saw that had medium term rentals at scale. And this is a company we're doing those property walks with and webinars with, and they have some great data. In fact, the owner of Key Renter Denver, Brandon Schulten, just over a year ago, he had a long-term condo in Capitol Hill. And of course, that market got really soft where it was, and also being a condo. So he was making not great cash flow, converted to medium term rental, and the cash flow went from, a few $100s a year to close to $5,000 a year. Now, this kind of goes to the numbers on there if you want to read it. But bottom line for him, going from a long-term rental to medium-term rental increased his net income by roughly almost $500 a month. It paid back the full setup cost in about a year and reduced downside risk during a period of soft rental demand. So it's a really great play for him. I think they have like over 50 properties in their portfolio now that they're managing as a company. So we have some great data, and I've definitely seen some great wins on this strategy as well. All right, so let's talk about option number 2 here, which is the cash out refi. Let's extract equity and then go reinvest. So this could be through a HELOC, or a lot of times a cash out refi that you go reinvest. Now, key point here that my mentors told me was anytime you do a cash out refi, you are essentially repurchasing this property at today's numbers and today's debt. Would you buy this property today? And in some cases, yes. In some cases, no. And I think a key question too is this a trophy or legacy asset? It's like just an amazing asset, amazing location. My assets, other than my primary residence, they are not trophy assets. They're just, C class, B class properties. I got other people, they own in Cherry Creek, they own amazing locations. All right, those are amazing assets. So you have to kind of determine on there, does it make sense to hold on to it, or should you look at doing something else with the property? So here's a couple quick examples. Cash out refinance to buy another rental. This is a paid off rental property on the left here. So it's like a 4-bedroom, 2-bath, single family house. So pretty common rental property, right? Class B, decent neighborhood, not amazing, not horrible, but just kind of like, par for the course, location, asset, all that. But a solid rental this guy's had for years. Paid off, he's making about $16,500 a year. If you were to do a cash out refinance, buy another similar rental here in Denver, keep this property, put new debt on it, buy a new property, his cash flow actually drops to about 2,000 a year. Why? Because the property he had is not a great rental, so it actually is negative cash flowing. The new property is positive cash flow, and that's how they're wiping each other out, or that's how they were getting those numbers. And so I'm assuming a 6.5% rate, 6% cap rate on purchase, and a 65% loan to value. Of course, you have to come in here and play around with the numbers, but this was a strategy I loved in the previous market cycle. All right. Another example here, and this happened a lot last year. So this is no one's true example here, but we probably had 2 dozen or so clients last year follow a very similar strategy. So that same paid off single family rental, but then did a 50% LTV. So they took it about, a little over $200,000 on this property and then reinvested it as a private lender. And this was with a private lending fund that was paying about, I'm estimating on here conservatively, a 16% annual return. So they keep this asset. And the one I'm thinking here in my mind is this is in Cherry Creek School District, great asset. They wanted to pull money out to buy another property and then also do some lending. So this is somebody that took out to do lending on here. So they kept their trophy asset in a great location, but now their cash flow actually increased because they would go out there and the money they borrowed is actually earning them a lot more than the interest rate, right? They borrowed at 6.5, but they're making a 16% cash on cash return. They got 10 points in there in spread. They can pay the debt, the interest on there, and they keep that 10 points as profit for themselves. All right, option number 3 on here. Which is sell and unlock your equity. The most common example is sell and do a 1031 exchange, which I have done. I know a lot of people in this webinar have done as well. Right, that was one of the old playbooks. Hey, sell your single family home, go buy a fourplex or go buy whatever, right? The problem is those numbers are tough for all the reasons we spent the last hour talking about. So now one of the plays, and this one I have done quite a few times myself, many landlords are selling, paying taxes by not doing a 1031 exchange, and they're investing in other assets to maximize their cash flow and minimize their headache. So here's an example of taking that same paid off rental property we talked about, single family home, and then doing a 1031 exchange into, let's say, a fourplex, $1 million fourplex with a 40% down payment, 8% cost to sell, transaction costs, some closing costs, some inspection items, and they're buying a 7% cap rate multifamily. So a pretty good deal in the market today, right? And to get these numbers, you might do some value add, but this is kind of like, let's say, a year forward once they've stabilized the property and done a few things to make it better. Cash flow increases by about $10,000 a year. They've actually seen cash flow increase. So the problem here is you're not going to be able to sell your house for the peak price, which I think is fine. It'll be near the top. You're going to be buying a multifamily, at a cheaper price, buying a great deal and getting better cash flow, but not amazing cash flow. Again, this is where you need to go into Property Llama or your own spreadsheet and look at real properties, real deals, get some debt quotes, look at the multifamily properties out there and see if the 1031 exchanges make sense for you. And if you have the appetite to go out there and, run a value add play on a property. Again, 10 years ago I did. 44-year-old Chris this year doesn't. So here's something I've done. This is the second option: sell, pay taxes, and then shift into a more passive investment. I'm using private lending, but there's, and these can be syndications, passive real estate investing, stock market, sell, pay taxes. This is the model for private lending on here. So same property on the left here. and I'm saying it's going to be a 30% cost to sell. That's not the actual cost to sell the property. That's that 8% to sell the property and about 22% in capital gains, depreciation, or capture taxes, right? Because you can't do a 1031 exchange in a private lending or most passive investments or the stock market. But private lending, real estate investors understand it. And it's also max cash flow, which is what they want. So again, very conservative on here in terms of like 30% cost to sell. And we're assuming a 16% return on private lending. I mean, I made some investments last year that were north of 20%, which is, those are great, but you can't find those all the time. But 16%, definitely go out there and find. Well, if we go out there and sell, cash flow about triples potentially, right? So more cash flow, less headache, and usually in a safer part of the capital stack on there. All right. So what's the right move for you? It depends. And I see some questions in chat here. I'm going to answer those in a few minutes. Everyone, I've not forgotten about you. But we got a couple more things I'll cover on here. What's the right move for you? My famous answer is it depends. It annoys the heck out of my team because they know what Chris is going to say. It depends, right? A lot of factors, a lot of variables. So my recommendation to you is you need clarity on two main items. First is understand your rental portfolio performance. Second is realign and clarify your goals. What do you want for cash flow? What's your risk tolerance? How much sweat equity you're willing to put in there? Because a lot of us started investing 10, 20, 30 years ago, and we've just been building and grinding and buying. And now it's like, oh, kids are out of college. Spouse wants to retire early. I might want to retire. Let's realign the goals here because we've been working, and let's make sure we're sticking our head above the clouds for a few minutes, right? So to understand your rental portfolio on here, go to propertyllama.com, create your free account, upload your properties. It'll take about 5 or 10 minutes per property. And don't worry about decimal points or dollars. Round out to nearest $10,000 or so. It's not going to make a huge difference in price, or you have to be down to the exact decimal. Get, 90, 95% good enough, and you'll get the broad stroke to like, oh, here's kind of where it sits. If you have any questions, make sure use that chat box in the bottom of the software, which is the best way. Or if you can't, email us, ir@propertyllama.com. But then go in there and review the property level cards like I did briefly in here, and like our training will tell you how to do in the software. And then start running some of those scenarios in the software. Let me show you real fast. Right here, run scenario. Do I want to do a cash out refi? Do I want to do a 1031 exchange? Do I want to do a passive investment? What do I want to do here? Come in here, put some numbers, and it'll build out a scenario for you very quickly, which is super, super cool. I just saw this question. How do I edit a property in here? Go to the property card and then look for this pencil icon here, Brennan. If you have trouble on there finding that, email us. We'll take care of you. But that's the way to edit on there. All right. Second thing, go out there and realign and clarify your goals. There's a spreadsheet I put together. It's a very simple spreadsheet. But these are key questions I ask myself, and I take my clients through over the years and just kind of go through what's the cash flow I want, or what's my current cash flow? How much do I want? And when do I want to buy? These are literally the $1,000,000 questions here. Know where you're going. Google GPS is useless to you unless you put in a destination. You have to know where you want to go. Then we can work backwards, optimize your portfolio. Then just ask you some questions about what type of investor are you right now, some questions about you and your properties, and just some really good questions to help you kind of like quantify where you're at. Recommend you do this with your spouse or business partner as well, to help you kind of just get framed in there as well. All right. Last section here, and we'll get the Q&A, is I want to share a couple of very brief updates on my investing strategy and my portfolio updates. Now, I think it was last month, I always release like my annual, very, very detailed investing podcast, investing strategy. I will link that into that resource page in here. We may drop in the chat as well if it's handy. As I'm thinking about this, but that goes in like very detailed, granular data on there. So review that if you want to. This is like the 2-minute version of it. Going back to the capital stack here, so I showed you earlier in private lending. And actually, one question we have on here is how secure is private lending? Typically, private lending is very secure because you're typically senior debt, meaning your first position on that property. You can be second position, which would be junior debt. And there's good opportunities for both out there. But typically, like that first position senior debt, you have you have the house, the apartment building, the office building as collateral on there. And if the person stops paying, you go foreclose on the property. And if you underwrote well, you should be able to get your money back and then some as well. So typically it's very secure. And so you want collateralized lending, right? This is not unsecured lending like credit cards. This is asset backed lending, meaning the lender, either you as a lender or the group you're working with, you have that first or second position on the property. All right. So high level, this is a broad stroke for my portfolio here. And this is my real estate section of my portfolio, which is the majority of my investments. I have a lot in the stock market. I love stocks, and a little bit of gold, a little bit of Bitcoin as well. But this is my real estate portion on here. I'm about 85% equity between rental properties, passive investment, syndications, multifamily partnerships, where I'm like part of the down payment, or I'm that common equity. Where'd my mouse go? All right. Well, that Google slide will come back in a second. I'm this common equity right here where I should get a higher return. I have higher risk. It's not been a higher return the last couple of years, but that's the market cycle, right? So I'm about 85% equity and about 15% allocated towards private lending, meaning that money is being lent out to fix and flippers and borrowers, for non-traditional lending on there. My goal is to get to a 50-50 balance. So 50% equity, 50%, lending or debt, whatever you want to call it. So I want to shift to that 50-50. So I say private lending / debt / credit / hard money. I get loose with my terms on there, but I just mean like being the lending side or the debt side on the properties. Why? Well, it's to maximize my cash flow and mitigate my downside by preserving my capital. So for most people, when you're young and early in wealth building, you want upside. So you go for growth. But as you get older and you actually start accumulating some assets, you care about less just growth, and will start protecting what you have while generating income. I kind of align this to like going from 100% stocks or 85% stocks to like 50% stocks, 50% bonds, right? Which what a lot of people do as they get older, they increase their bond portfolio and decrease their stock or their stock allocation, I should say. So very similar thought process here for real estate. So my guesstimate is it'll take me about 3 to 5 years to rebalance my portfolio. So this is new money I'm investing every year. And of course, as properties cycle through, I can sell properties. I will get money back. And I should have a few multifamily exits next year. Or I'm sorry, this year in 2026. I'll get that money back and I'll start redeploying it into more lending. But it's going to take me a couple years to rebalance just based off owning the properties, good times to sell. And like many real estate investors, I'm not as liquid as I used to be, right? I got to go out there and sell some properties to increase liquidity. So that's me as an investor. Now, I'm a big believer, along with the Property Llama team, that our goal is to go out there and find the best investment opportunities in the market. And we identified the 6 we think that make the most sense in Colorado right now. And for the most part, a lot of the national market as well. And then I want to build a business around that same trend. I call it like stacking things together. I believe when you go out there and as an investor, I want those best deals out there. I'm going to take more mindset, more intention, sharpen my skills, find those opportunities. You get that 1 + 1 + 1 = 9. You get that exponential result, right? So Property Llama Capital which is our business helps structure a lot of these bigger and passive deals. We're focusing a lot more on cash flow investments, mostly through private lending right now. So we'll talk more about that at the uh, deep dive webinar on January 21 in about 2 weeks. But for me as an investor, I'm shifting more towards lending. And then where I'm putting our business focus as an entrepreneur, we're shifting more towards cash flow, primarily through private lending as well. All right. So with that said, that is the webinar. I have a couple links on here. We'll drop. I'll get a few questions on here. There's 2 links on here, and these are also on that page I showed you a few minutes ago. One is to come out here and fill out what investment strategies you're interested in. And the other is to kind of share what mastermind groups you want to sign up for. So here is, come in investment strategy, pick one, pick some, pick all, pick none. But pick the ones you want to choose. We'll do our best to get you detailed follow-up information. Some of these we do, like private lending, and some of these we have great referral partners out that we can connect you with to go out there and get you more details and maybe even do a deal together. Because we do these educational webinars to go out there and do deals. The other thing is that other link will go out to the mastermind forum. Choose the ones you're interested in. This is the first round we have. We'll have more coming up for that last part of the mastermind. But right now, these are the ones we have scheduled. So choose the one you want to come into, and we'll get you the details on here as well. All right. Awesome. You are welcome. I see a lot of thank yous in the webinars here. So if you guys have to run, go. Otherwise, I'm going to hang out, answer some questions here in the chat box. But I love it that someone says, phenomenal info. That is a huge compliment. So thank you very, very much. All right. Let me go back up here. Question. When do you feel that you are over leveraged? So, loaded question on there, of course. But my goal, where I sit as an investor, and I think this is also a smart position to be in, is I target to be around a 65% LTV. So loan to value, right? So if I have a $10 million portfolio, around $6.5 million or 65% can be leveraged. And the reason I say 65% is this was years ago. Doing analysis of the great financial crisis. And actually, let me go back to the earlier slide on here of like, okay, well, if the GFC, the great financial crisis, repeats itself, right? We saw about anywhere, depending on the market, a 20 to 30% decline in values on there. And that was pretty common for Denver or for Colorado. Also, a lot of markets around the country was, a 20 to 30% decline. I was like, okay, well, if we have a 65% LTV, that means price would have to go down 35% before I'm underwater. So worst case, if I have to sell at the worst time because I have a family emergency or I just have to unload the property, I should be able to sell it, pay for fees, and hopefully walk away with a few bucks. Same thing with multifamily, right? Let me go for this multifamily side. Depending on what market and asset class you're in as well, multifamily is declining anywhere from about 10 to 30% right now from different asset classes and locations that I have seen. And so I personally try to stay at 65%. I think for me, 65%, I like leverage. I still want growth. I am not a fan personally of owning paid off rental properties. I'd rather have that invested elsewhere. So I like some leverage on there. I like the 65% LTV on there. Again, price is what on here. This is Colorado Springs went from 280 to 240. So that's a 40,000 decrease. So what's that? 15 or 20%. I'm doing live mental math, which is tough. But again, decrease here, right? Buffer on there for what we're looking at. This has been very extreme. That's what we see. But I think it was Nicholas who asked that. I like to be at a 65% LTV personally. And I've seen a lot of people who are much smarter than me, older and more market cycles, have a much bigger net worth than I do. And a lot of times they're between like at 50 to 65% LTV. So that's where I like to be. Ah, I love it. CeeLo. Thank you. Wow, this is awesome. Thank you guys so much. Um, I appreciate the thank yous, but what questions do you have? Um, Here's a good question. Patty said, I was just told that debt financing is very risky. Very broad stroke, right? Um, all investing is risky, right? So let's be real there. All investing is risky, and we'll go into more of that in our webinar in 2 weeks, Patty. But all investing is risky. So I will go say that all investing is risky and you can lose money. And if you invest long enough, you will lose some money, right? But you have to contextualize that right now. Like you see a lot of headlines right now, and it says, private credit, private equity credit, really risky right now, really frothy. They're talking about like, in that case, like business lending, private equity lending to other businesses. Um, and I think a lot of that they're kind of like the frothy part of the market cycle. And that is where people are lending money to businesses or they're taking out debt on businesses to go out there and fund growth. Um, that is in the current market cycle, in my opinion, kind of at a risky stage. Real estate, you have to understand here, we've already had our prices crash, right? So you have to become, hey, if prices crash, do we think single family homes or multifamily prices are going to crash much more? I don't think so. Like they may go down a little bit more, but they're going to drop another 20 or 30%. I have a really hard time believing that. So you have to understand what asset class it is in, because I see a lot of people get confused based on headlines or they get general advice. Oh, debt is risky. Well, what are you debt financing? And then what's the collateral? Are you doing, um, lending that's uncollateralized? Are you giving Chris Lopez a personal loan, essentially a credit card? Yeah, that's risky. Are you giving Chris Lopez's fourplex a loan where if I don't pay, you take back my asset and it's sitting at a 65% LTV? I consider that less risky. So it has to be contextualize that, but great question. And yes, all investing is risky. I'm going to be a broken record on there. Um, Crystal ball. Yeah. All right, Maria. Crystal ball. If I'm looking to sell a rental property that's 3 units, wouldn't it be a better time to sell? Um, Not today. Uh, there you go. I tried to sell a fourplex. I think it was last year. This time last year, I withdrew from the market. I'm going to be sitting on for probably for another 2 or 3 years. Is my best guesstimate. Now I'm at like I think a 50% LTV on that property, so I'm not high or low leverage. I'm kind of like middle of the ground. I think in 2 years would be a much better time to sell. But if you are selling a duplex, triplex, or fourplex, make sure when you list the property, you have 1 unit vacant because then a house hacker can buy the property. We see a ton of those duplexes, triplexes, and fourplexes being purchased by house hackers now. They're probably one of the biggest buyers in the market right now, but they can only buy the property if they can move into one of the units. So I would make sure it's vacant or 1 unit. I'm sorry, 1 unit's vacant. And I think 2027 will probably be better than 2026 as hopefully interest rates soften very, very slightly and marketing conditions improve. But if it's a paid off rental property, you have to look at the opportunity cost and say, hey, I bought it here. I'm selling here. So, I bought it here for 180 a door. I can sell it here for 240 a door. I'm using arbitrary numbers on this graph here if you're not seeing my screen. Okay. I'm just going to sell it because that will free up $500,000 for me and I can reinvest and make a smarter investment. But I think 2027 will be a lot better than 2026. Can you do a 1031 exchange in debt funds? No, unfortunately, you cannot. Um, and that's because a 1031 is for a like kind asset, right? I have to buy a similar asset. So, a house to house, or you can go like, some other alternative assets, but lending, you're lending money. You don't own the property. You're just lending money. So punchline is no, you can't. Unfortunately, you can't. I wish you could, but no. Michelle, ooh, great question. What do you think about splitting a duplex in this market? I love this question. I think that's a lot better play than trying to sell a duplex right now. So what she's saying, hey, get a duplex, and then it's one address, one owner, one loan. But then you split it or you put up a party wall. So there's that one common wall in the duplex here, and then you go through a process with the city or the county, and then you legally make it from 1 unit to 2 units. So now you're not at 123 Main Street. You have 123A and 123B, and then you can sell unit A to someone and unit B to someone, and it opens up a much better buyer pool for you. I forget the exact stat. I've not done these personally. I've been in deals, but I've not done it personally. But it was a gentleman I talked to about a year ago, and he did. I mean, he's done hundreds of them, and he estimated about 20% of duplexes in Denver County had been split and sold. So I think that's a really good option to look at. And Maria, that might be an option for a 3 unit as well. Should I open a separate LLC for each property or combine a couple per LLC? We're talking about asset protection on there. Again, not legal advice. We have some really good resources on there. Let me see if I can find that really fast. See if this link still works. Here, go here. This question. For should I split it into an LLC? Loaded question. I just dropped that in the chat on there. Denver Investment Real Estate /LLC. And here, let me share my screen on here too. This is I think a podcast webinar we did. 5 years ago now. But it was me, a great lender, Joe Massey. I think we had one other person on there as well. And we kind of go through the process, how it makes sense, what should you do. What I did, and I see it's very common, I had a master LLC. So, that's the top, the circle top. And then I had a sub LLC that owned individual properties, and a couple I batched them together as well if they were similar or if they were like condos in the same complex. Yeah, Michelle, you may want to reach out to Matt Malloy there about potentially splitting. He had some good resources on there. Nelson, I see ADUs around our neighborhood, most completed, minimal still in progress. Can you please share your quick notes, thoughts around ADUs? I can write a book on that, Nelson, for my thoughts. I was all on the ADU train a number of years ago. I'm no longer on the ADU train. I just think it's a very slow moving market. I liked it because you kind of get kind of like a duplex. So I'm sorry, let me back up. If you don't know what an ADU is, that's an accessory dwelling unit. So that is like that little carriage house out back, or the unit above the garage, or maybe like an apartment suite in the basement, right? A second living unit, but it's a single family home, not a duplex. They're kind of like all the rage and headlines right now, but only a couple hundred at most are being completed throughout the Denver area. I think building one is very expensive, and numbers don't make sense. Anytime I run the numbers, you've been better off just taking the money, buying another asset. There are some better loan products out there, but you run into financing issues. A lot of times I've seen the issues of, I've seen this happen where someone spent $250,000 in ADU, and the appraiser says, oh, that adds $100,000 value of the property. Kind of puts you upside down and try to do a cash out refinance. I bought a property with an ADU. I was like, I don't want to build one. Let me buy one, right? And go out there and put a low down payment because it's not a multifamily, and go buy one. But most ADUs that you buy, especially if they're older, they are, this is the most polite way I can say, they are a snowflake. They've been, homeowner, handyman, jerry rig, connected and this. There's some funkiness to it. Sewers are cut in or electrical's cut in. And I own the property. It's the biggest pay in the property. And I'm like a scale guy, operational efficiency guy. So it did not go for me. I've seen other people have that. I think, here's a good one. So Paul DeSalvo, who's on the Property Llama team and a great investor, he's got a house, I think Berkeley or Sunnyside, Paul, somewhere in that area, North Denver area. And he's in the process of totally gutting a house, building ADU. I think it's supposed to be done a year ago. few black eyes, not done yet, progressing along, but he's typically do a property walk, hopefully in February at his site where he's building ADU. A great discussion, so come to that. But high level, I'm not a fan of building an ADU unless you're building it for like your man cave or your she shed or your your parents, your kids to live in, or it's like a high end one for investment. I don't see the numbers panning out. You're welcome, Nelson. You're welcome, Michelle. You're welcome, Matt. Um, cool. I know we still have over 50 people on the webinar. Awesome. I'm happy to hang out for a while. What other questions do you have out there? You're welcome, Patty. Yeah, I'm really glad you guys enjoyed this. I know it's a lot to digest, and I feel like I fire hose people because I cram like the last 3 months of research into what we're 90 minutes on here. So as you go through this, getting any questions, reach out to me, reach out to the Property Llama team. We're happy to give you our thoughts on the market, our thoughts on how you can optimize your portfolio. Again, no advice, but just give you thoughts on what we're seeing, what we're doing with our own money. And I'm very transparent with the moves I'm making. And happy to connect you with a couple deals that we're doing this year. And we're very much focused on private lending, cash flow focused deals on most of our deals this year. Or we know other people, multifamily, build to rent, co-living, medium term rentals. We can give you some high level strategy and insights, but also make some phenomenal introductions as well. Oh, you guys are welcome. Oh, great question from Ann here. What kind of occupancy rates have you heard from people who operate co-living properties? Take this with a big grain of salt, Ann. I am not nearly plugged in that asset class as much as the other ones I've talked about. Um, I know for like the pad split where people use like third party management companies, they're at a lower one. I've heard in Denver they've been lower than anticipated. I think it probably I'd say in like the 80% occupancy range. Again, this is stabilized once you filled it. I've got a couple really good friends here. Jeff White in Denver, Miller McSwain in Colorado Springs. I mean, I'll be right back. And I can make some. I mean, Miller, he's a client and friend, but he last year he published. He's the author of a Bigger Pockets book, the Bigger Pockets Guide to Co-Living with Cash Flow, and he's built a nice little Colorado Springs empire down there. I mean, once those properties are stabilized and they have their management system in place, I mean, those guys are consistently in like the mid 90 occupancy. They are crushing it. But they've put the time and energy in creating systems. But if you do it well, I mean, you can have they're great assets and can be in like the 90 plus occupancies I've heard from a lot of like dialed in operators. Do you feel that these numbers are close in the Midwest? Um, Very, very, very loaded question on there. I mean, assuming Midwest, Iowa, Ohio, things like that. Um, I've done a lot of investing through syndications in Iowa, just when my good buddies has great operations out there. So I've done investing in other states, but Iowa's been like the main out of state market for me for like buying multifamily. And those markets are I would say a lot more stable than like Denver has been and like the Sun Belt, where we have seen our prices like peak and drop. Let me see if I can find a little chart here real fast. And we've seen our prices go up and down. They've been a lot more stable, right? They don't have like the big increases nor the big declines. They've been a lot more stable in terms of prices, rent ranges, occupancy. They've definitely had, I'll say, more of a correction, less of a crash. In terms of multifamily, I don't know single family out there, but they've been a lot better than like Colorado multifamily has. A lot less just dramatic. John says, "What do you think of selling a duplex to a house hacker with a seller financing on a wrap?" I'm intrigued. I have to see the numbers on there. Um, I think my problem with the wrap, and I've never done these. I'm not an expert. From people I know doing the wraps in Colorado, are much harder than other states. I've seen a lot of people go buy the PACE Morby course. Much harder to implement here in Colorado. Seller finance, I'm a big fan of. The wrap financing, if you can make it work, I think it sounds great on paper, but I don't have enough knowledge on there to give you a good answer. But I'd actually love to see the numbers on there, John. Can you put that book reference on there, please? Yes, I will make a note here to put that in the page, but it's also I'll just say the Bigger Pockets Guide to Co-Living Cash Flow. There you go. I'll see if I can find the Amazon link for you real fast as well. Oh, there we go. I think Richard beat me to it. He put the Bigger Pockets link on there. Also check Amazon. A lot of times their bookstores cheaper than Bigger Pockets. Don't tell Bigger Pockets I said that. Um, but we've got some really good webinars we've done with Jeff White here in Denver and Miller down in the Springs. If there's a lot of interest in co-living, I'm happy to share those webinars, or we're going to do an update one this year and get one or both those guys on there. But they're kind of like my go-to guys for co-living because they absolutely crush it. Miller's doing his own stuff. Jeff does his own stuff up here for Room by Room. He's also an agent. So if you're looking to learn or buy in those markets, let us know. And Jeff and Miller are great resources. There we go. Thanks for posting the Amazon link, Richard. All right. I think that's all the questions on here. We'll do a quick scan. All right. So I know with these webinars, we have well over half the people watch the recording. And of course, as you go through the information on here, you're going to probably have more questions once we hang up. Feel free to reach out to me, reach out to the team. Best way to do it is at ir@propertyllama.com. That goes to, I think, 6 people on our team: myself, Alona, Richard, Matt, Christy, Paul. I think those are 6 people on there. So it goes to the whole team. So some will see it. A lot of times we'll defer to someone else who's, hey, you know that better than I do? Hey, Christy, you answer that, or Paul, you answer that, right? Awesome. Well, I see no more questions coming in. I see a lot of people dropping off the webinar. I just want to give a big thank you for everyone coming out. I appreciate you taking about 2 hours every day. I know it's a big ask for your time. I'm greatly privileged. I know our Property Llama team is as well. Happy New Year. We're looking forward to making 2026 a better real estate year than 2025 and 2024 were. But we're excited about this year. We're excited about the opportunities we're seeing, and we are pumped moving forward. So everyone, have a great day. Have a great week. We'll see you in future masterminds, webinars, and property walks. Bye, everyone.